Welcome to our deep dive into the $50,000 foreclosure trap. Today, we will unpack how certain mortgage features from the mid-2000s set homeowners up for sudden, massive cash demands, and more importantly, how to spot and mitigate those risks now. Let's move smoothly from the big picture to the exact mechanics, then to practical steps you can take. Here's the big picture. Sudden cash demands around $50,000 often trace back to three features common in pre-2008 mortgages: balloon payments, negative amortization, and underwater refinancing requirements. As teaser periods end and home values fall, these features can trigger lump sum paydowns or make refinancing impossible without substantial cash. Next, we'll outline our roadmap so you know exactly what to expect. Our roadmap starts with a definition of the $50,000 trap, then moves into the three primary triggers. After that, we'll look at real numbers, diagrams, and a simple calculation framework. We will finish with an action plan, and along the way we'll check your understanding with quick quizzes. Let's begin with what the trap actually is. The $50,000 trap is a sudden demand for a large lump sum payment triggered by certain mortgage features when market conditions turn. Adjustable rate or piggyback loans, often planned for refinancing later, assuming home values would rise. When values fell, borrowers couldn't refinance, and three mechanisms: balloon payments, negative amortization balances, and cash-in requirements due to underwater LTV, forced immediate paydowns that could easily be $50,000 or more. Next, we'll dive into the first mechanism: balloon payments. Balloon payments commonly followed a teaser period of low payments, often 3 to 5 years. The plan was to refinance before the balloon came due, relying on rising equity. When home prices dropped, that assumption collapsed, and borrowers were asked to pay the balloon in cash immediately. This is one of the most common reasons borrowers suddenly saw a $50,000 demand. Now, let's transition to how you can identify a balloon in your own paperwork. To identify a balloon payment, review your promissory note and loan estimate documents for explicit balloon language, a balloon due date, and a large final payment in the schedule. Ask your servicer directly if a balloon exists, and request both a payoff statement and full amortization schedule. If a balloon is confirmed, add reminders at least 6 to 12 months before the due date to explore options early. Next, we'll move on to negative amortization. Negative amortization occurs when your monthly payment is less than the interest accruing, so the unpaid interest is capitalized into your principal. Your balance grows rather than declines. In a declining market, this makes refinancing difficult and risky. Lenders may require a lump sum paydown to stabilize the loan or meet conventional guidelines, and that amount often lands around $50,000, depending on the accrual period and rate. Now, we'll turn to underwater refinancing and required cash-in paydowns. Underwater refinancing happens when your home value falls and your loan balance exceeds program LTV caps, often 80% for conventional refis. In that case, lenders may require you to bring cash to closing to meet the target LTV. The formula is cash in equals your current balance minus the target LTV multiplied by current value. This can easily amount to tens of thousands of dollars, frequently around $50,000. Next, let's look at a quick LTV table to ground the math. This table illustrates how cash-in is computed. For example, with a $300,000 home value and a $290,000 balance, the maximum loan allowed at 80% LTV is $240,000. The difference, $50,000, must be paid in cash to meet the LTV. Conversely, if your balance is already at or below the max, no cash-in is needed. With numbers in mind, let's visualize the full life cycle with a timeline diagram. This timeline should depict the borrower's journey: a teaser rate period, optional minimum payments leading to negative amortization, a midstream decline in home value, the end of the teaser and a rate adjustment upward, and finally a balloon payment coming due. It should also note the original assumption that the borrower would refinance before the balloon, and the alternate path where declining values force a cash-in to meet an 80% LTV cap. Now, let's compare ARMs with fixed-rate loans to see structural differences. Adjustable-rate mortgages typically offer lower initial payments but expose borrowers to payment shocks, potential balloon features, and negative amortization. They rely more on the ability to refinance, which is jeopardized if values decline. Fixed-rate mortgages generally provide stable payments without balloons or negative amortization, reducing reliance on future refinancing. With that context, let's move to a practical, step-by-step action plan you can apply right now. Start by gathering your core documents and calculating your current LTV. Identify whether your loan has a balloon, negative amortization provisions, or upcoming resets. Request a payoff statement and amortization schedule to understand your true balance trajectory. If your LTV is above target guidelines, compute potential cash in. Call your servicer's loss mitigation department and ask about options such as a modification, rate relief, term extension, or principal forbearance. Shop multiple refinance paths, and consider consulting a HUD-approved housing counselor and a real estate attorney. Finally, document all interactions and set firm deadlines to keep momentum. Now let's check your understanding with a quick quiz. Quiz time. The question is, which loan feature can cause your balance to grow over time because your payment is less than the interest due? Options are A. Balloon payment, B. Negative amortization, C. Fixed-rate mortgage, and D. Interest only with full interest paid. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Negative amortization. This feature capitalizes unpaid interest back into the principal, increasing your balance even as you make payments. Next, let's try a quick cash-in math check. Next quiz. Your home is worth $300,000, your loan balance is $290,000, and your lender requires 80% loan to value to refinance. How much cash-in is needed? Options are A. 0, B. 10,000, C. 50,000, and D. 80,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $50,000. At 80% LTV, the maximum loan is $240,000. The difference between your current balance and that target is $50,000. With the math solidified, let's capture the key takeaways. Core lessons. The $50,000 demand typically arises from balloon payments, negative amortization accrual, or underwater LTV cash-in requirements. Falling values undermine refinancing assumptions. Know your numbers, LTV, payoff amount, amortization, and reset dates, and act early with your servicer. Seek professional help when needed. Before we wrap, here's an important disclaimer. Disclaimer. This content is educational and not legal, tax, or financial advice. Mortgage rules and options vary by state and lender. Consult a HUD-approved housing counselor, a licensed attorney, and a qualified financial professional regarding your specific circumstances. All examples and figures, including the $50,000 scenarios, are illustrative. To wrap up, identify whether your loan contains high-risk features. Run your numbers, including LTV and potential cash-in. Engage your servicer early to explore loss mitigation or refinance options, and consult professionals to evaluate alternatives. Finally, let's close with a thank you and a quick call to action. Thanks for watching. If this video helped you understand and avoid the foreclosure trap, please like, share, and subscribe. Tell us your experiences and questions in the comments. We read them all and may feature your questions in upcoming videos.